All right, what's going on, everyone? Welcome back to the channel. My name is Irvin Pena, also known as Irv Official, and it's no surprise that right now one of the most common questions being asked is right now a good time to buy a house, and if so, how do I buy a house in 2020? So I decided to make a step-by-step guide for how to buy your first home. And come to think of it, I'm a little surprised that I didn't already create a video about this topic, not so much because so many of you guys were asking me about it, but because I've sold millions of dollars of real estate. I've been licensed for over 7 years, not to mention that I've been featured on the South Florida Business Journal for developing commercial real estate in South Florida and Miami. So you can say I know a thing or two when it comes to buying and selling a property. Now, I've been on both sides of the board. I've helped people buy their dream home, and I've helped people sell what they thought would be their forever home. And so I wanted to go ahead and make a video though, specifically around how to buy your first home without skipping any steps. So consider this your step-by-step tutorial and really everything that you'll need to know when it comes to purchasing a property in 2020 and beyond, unless something crazy happens and all of these guidelines change, which apparently it's not looking like it. And so my hopes with this video is if you are buying your very first property, then you can use this video as your step-by-step guide when it comes to purchasing your possible forever home or even your first investment property, because with one of these techniques, you can actually leverage it to your advantage to purchase your own rental property. So yes, this video will be a little longer than what I normally post, just because I wanted to have one video packed with as much concise and clear information as possible at your fingertips. And so the only thing that I ask from you in return is that you hit that like button down below, because apparently the YouTube algorithm gods bless videos like this that have a lot of likes. And don't forget to comment down below really anything at this point, just because again, it helps out with pushing this video forward in front of more people. So without further ado, let's go ahead and jump right into the first step. So the first question that often comes up, and it really leads us to the first step, is, Irv, how much money do I need? What's the down payment like? Now, the amount of money that you need for your down payment is going to be directly impacted by the type of loan that you get. Let me explain. You see, the majority of home buyers either end up getting an FHA loan or they end up getting approved for a conventional loan. Let's first talk about the conventional loan, because if you are going to buy a home with a conventional loan, you need anywhere between 10 to 20% down of the purchase price for that property. So let's say that you're looking at a property that's right around $300,000. That means that you will need a down payment of anywhere between $30,000 to $60,000. Now, when you compare that to the FHA loan, which is only 3.5% down, that means that you only need roughly about $10,500 for your down payment, again, for a FHA loan. Now, before you say, okay, I'm done, let me shut off the video, let me go with an FHA loan, let me explain to you some key differences that you should probably know about. You see, when it comes to getting an FHA loan, they are seen as a higher risk to banks. Even though they are federally granted, they are seen as a bigger risk and a higher possibility of actually defaulting or being foreclosed on. And the reason for that is because it requires less money down and the credit score doesn't need to be as high with an FHA compared to a conventional. Now, something that would directly impact your monthly mortgage would be something called a PMI. Now, PMI, what it stands for is a private mortgage insurance. Now, that comes on both a conventional and an FHA loan. The difference is that on a conventional loan, it comes off either after you've given a 20% down payment or after you've paid off 20% of the principal from your mortgage. Comparing that to the FHA, well, it never comes off. And lastly, when comparing both of these loans, something else that you need to keep in the back of your mind as you go out shopping for your first property is, well, with an FHA loan, it will be capped at a certain amount that you can actually use toward buying a home. So for example, if you are looking at $1 million property and you have literally 3.5% down to put down toward that property, well, unfortunately, FHA will not be able to grant you that loan because it will be capped at a certain amount. Now, if you're wondering how much money you can actually get for an FHA loan or how much buying power you would actually have, that's all going to come down the area that you live in, and I will share with you exactly how to find that out later in this video. Now, in my opinion, when it comes to negotiating on either a conventional loan or an FHA loan, and I'm out either shopping with the client or I'm on the back end and I'm representing the seller, 9 times out of 10, with an exception of maybe one case, I would go ahead and see the conventional loan always beating out the FHA offer. And the reason for that is because, again, it goes back down to conventional loan buyers often have a higher credit score, a stronger job history, and more money on the table, which makes the underwrite process run a lot smoother than it would for an FHA buyer. So now that you figured out the type of loan that you're going to be using, let's now talk about how much money you have to save, and that's all going to come down again to the type of loan that you have. Because right now we do know that there are some programs out there that are conventional that are competing with the FHA loan at 3.5%, and well, instead of offering that 10 or 20% down to get a conventional loan, again, there's some programs out there that are now offering it at 3%. And so one of the fastest ways to find that out is to either visit your local bank or contact a loan mortgage servicer or loan officer, really. Now, once you contact them, they'll be able to guide you on exactly how much money you need to save. But a good rule of thumb is 3.5% for, again, the $300,000 purchase. That would be $10,500. And then if you are buying a $300,000 house for a conventional 10 or 20%, then again, that would be roughly right around $30,000 to $60,000 that you would need to save up just for the down payment. And that's not including closing costs, which we will get further into that in one of the later steps in this video. Now, the first two steps mean absolutely nothing if, well, we don't have the third step in place, and that's having a good credit score. You see, think of it like this. When it comes to having a good credit score, it's kind of like going to the bar and paying for the cover charge to get into the bar or to the lounge or whatever you do for fun. But once you're actually in the lounge or once you're actually in the club, what ends up happening is you notice, I still have to spend more money now that I'm here. So think of it like this. Your credit is your cover charge to get into the party, and then the down payment that you have in the cash reserves actually serves as you being able to pay to play. Because what good is $200,000 in the bank if you're buying a $400,000 house, but you only have a 250 or 300 credit score, right? It defeats the purpose of everything. So going back to the FHA loan, while it only requires a 580 credit score to actually get pre-qualified and approved for that type of loan, in contrast to about a 650 credit score to get approved for a conventional loan, they differ because this would actually mean that you would have to end up paying more money in interest. Now, if you are someone that possibly has a 750 and up credit score, then you are golden, because at that point, banks are going to treat you a little bit more differently than they would someone who possibly has a 590 credit score that has an FHA loan. Meaning they are going to give you more rebates, they're going to give you some more credits, your interest rate is going to be significantly lower. So in the back end, even though you possibly had to dish out a little bit more money to maybe buy your home, your monthly payment can ultimately be lower than someone that's buying an FHA type of loan for their property. Now, without spending too much time here, one of the best ways that you can improve your credit score is make a list of all the debts that you have and start chopping them down little by little. I personally enjoy Dave Ramsey's baby steps, where he has you list them from largest to smallest, and then you start knocking down the smallest debts first, working your way all the way up to the largest debts, causing that snowball effect of paying down debt. Now, paying down as much debt is important, not just because it helps improve your credit score, but because it also helps with something called a DTI. That's known as a debt to income ratio, and that's what loan officers and banks are going to look at when you are applying for a mortgage. So simply put, debt to income ratio means how much money you have coming out on recurring debt, like your car payments, if you're paying on your student loans, credit cards, if you have alimony, things like that that you pay out. And then they tack that on and they run it with the ratio compared to how much income you have coming in every month. So let's run a quick scenario on that. Let's say that you have a gross income of $5,000 coming into your house every single month, and then they tack on the $1,500 that, let's say, your mortgage, your taxes, and your HOA is going to be for the property that they are pre-qualifying you for. Then you tack on another $1,000 for recurring debt. That's kind of like your credit cards, alimony, car payments, things like that. That puts your DTI, or your debt to income ratio, right at around 40%. Now keep this in mind. If you're applying for an FHA loan, then they'll let it slide with possibly 50%. That's a little high, but they will let it slide of a debt to income ratio. They'd rather see you somewhere along the lines of a 35 or 36% of that DTI. Here's a quick smart money tip for you. If you are calculating your DTI for your personal finances, I would recommend, and this is what I tell my clients, don't do it off of your gross income, do it off of your net income. Now that we have those first three steps in place, it's now time to get pre-qualified. And the reason you want to get pre-qualified before you go out shopping for a home is because it's going to save you a lot of time. What's the point of looking at something that's overpriced and well out of your budget? I mean, it could be $300,000, $400,000, but if you are, let's say, looking to stay under a $1,700 monthly payment, then what's the point of really looking at that, right? You're just gonna be wasting your time, and if you're working with a realtor, you're most likely going to be wasting their time. So when it comes to getting pre-qualified for a home loan, this is what lenders look for. They look for things like job history. How long have you been at your job? Are you bouncing around? And if you are bouncing around, are you going from the same industry? Meaning if you were at one restaurant job for 6 months and then you moved to another restaurant job and you were there for 1 year, that's a jump, but it stays within the same industry. They like that. They see that as a strong candidate for a home loan. They also look at things like your pay stubs as well as your tax returns, your last 2 years of tax returns. Now, if you are self-employed, then this step is going to be even more crucial for you because they're going to ask you for just about everything in your transcripts. And now if you're not sure of what that is, then make sure to contact your personal CPA that they can walk you through that and make sure that they give you all the documents that you need in order to be able to purchase your home. Bank statements is the next one. They are going to be looking at anywhere between 2 to 6 months of reserve. Now, one pro tip that I will give you here is try not to have too many cash transactions coming in. Meaning, if you are getting paid, try to find a way that maybe you can get a letter written from the people that are paying you, or if someone is depositing money into your account, try to see if you can either have a letter written from them or if you can maybe have that come in some form of check. The reason for that is because once banks start to see a lot of money coming in and out of your account that's just cash transactions, well, there's no way of them actually back tracing that. And if they can't backtrack that, well, that means that it can't get through underwrite. And if it doesn't get through underwrite, then unfortunately, they can't use that income as proof of income for you. And a few other things that you should know about, and I'd be doing you a disservice if I didn't tell you this, is if you have other properties that you possibly rent out or that you own, maybe you already have a loan and you're looking to possibly apply for a second mortgage on another property, then they are obviously going to request information on that and proper documentation. Things like 401k, if you own any type of stocks, if you have bonds, as well as employer verification forms, pretty much letting them know that you are still employed by who you say that you're employed. And of course, that would be notarized and possibly signed off by your employer. So I didn't want to leave you hanging with that because that is a crucial part of step 4. All right, we have step 5, and this question right here is probably one of the most Googled or YouTube questions you can possibly find. Is now a good time to buy a home, or should I wait for the market to crash before buying a property? Now, on whether or not to actually buy a home, now it's all going to come down to your preference. Are you buying a home because it's an investment property? Are you buying a home because you want to move to a better school location? Are you buying a home because you are being relocated from your job? You see, every scenario is different. Now, if I'm an investor, I'm going to be very careful in buying properties that are maybe short-term vacation rentals, just because we see how the vacation industry is getting hit and how the travel industry has been getting crushed, from airlines to cruises. And so is it wise for me to right now put my money into maybe just a pure vacation style home? Maybe not, at least where I live. This is just a generic overlay for your specific area. If I'm going to purchase a home, and let's say in an area that's being developed and they're putting 4 or 5 different shopping centers around it, a brand new state-of-the-art movie theater, on top of that, they're going to add on a brand new school in this district, and it's going to maybe make it a top-rated school. Then at that point, if you are comparing apples to apples, then of course that investment would be possibly better for you in the long run, because if you buy it at $250,000, then maybe a few years down from the road today, that same investment could now be worth $350,000, $400,000, and that's $100,000 worth of equity on top of what you've already paid into the property, just built in naturally. So those are a few key things to consider, not to mention that right now interest rates are significantly lower than what we've seen in the last 50 years. Just to put this into perspective, right now they're sitting at right around 2.8% for a 30-year fixed. Comparing that to where we were in January, they were sitting closer to 4% when the year first started. To hire a realtor or not to hire a realtor, that is the question, and that is going to come down to a personal preference. My answer to you is, if you know enough about possible contracts, legalities, negotiation tactics, and you can maybe go ahead and go off on your own boat, even if you've studied the market and you know it maybe better than every other realtor in the area. But if you do want to be protected and you do want that legal backup, because most realtors, at least the good ones, they not only roll with the proper credentials and a legal team, being that they're backed by their brokerage, but they also know the market, or at least they should know the market inside and out. Now, one suggestion that I do give is, while you are searching for realtors online, don't forget to use word of mouth and use your sphere of influence as possible talking points to find out who's a good realtor and who's not. Maybe there's a realtor that goes to your local community club, or maybe there's possibly a best friend that you have at a church that's a realtor and they actually know the market pretty well. Or maybe your mom just finished buying a home and you like the way that that realtor treated her and you want to go ahead and sign up and work with that same realtor. Now, when you're working with the realtor on the buy side, it costs you absolutely nothing. And so I never understood why most people never liked working with realtors, especially good ones, since they're free for you as the buyer. So up to this point, you've saved up enough money. You've finally fixed your credit. You have a realtor that you decided to work with and that you trust, and you know exactly where you want to live. I don't need to bore you with the details of the type of home that you want, because that's going to come down to personal preference. After shopping for 100 homes, and don't be discouraged if you put in 100 offers to finally get one accepted, that's just part of the game. That just naturally happens, especially if you are in a seller's market versus a buyer's market. And simply put, a seller's market just means that there's less inventory on the market and there's more buyers shopping around in that area. And a buyer's market, simply put, is that there are more homes on the market and less buyers looking at those homes. And congratulations, your offer has been accepted for the home that you've chosen. And so these are the steps that follow for that process. When you are under contract, you now have entered a due diligence period. In that due diligence period, you now have anywhere between 7 to 15 days, at least for here, the state of Florida. This is why you want to double check with your realtor in your area how long your due diligence period is. Simply put, this allows you to get in or out of a contract if, let's say, you guys can't reach an agreement even after you've signed up to purchase that property. Here in Florida, if I'm working with the client and I'm working with the buyers, we request 7 days of, let's say, a due diligence, and we get that accepted. Well, that's going to mean that if we find anything wrong with the property, or even if they wake up tomorrow, as long as they're within the 7 days after executing the contract, they can back out and they would get their escrow deposit back. We have the inspection, and we never want to disregard the inspection. It doesn't matter if it's a brand new construction. I can't tell you how many times I've seen new homes, literally brand new homes built this year, and they go to plug in the blender and the blender doesn't turn on. And the problem is that if you don't have the right warranty in place or the right insurance, well, that's gonna come out of pocket for you. So I always recommend, even if it looks like a stellar home, even if it's been completely gutted, always do an inspection of the property, because you want to know if it sits in a flood zone. You want to know if the home is settling. You want to know if the home is caving in. You want to know how old the roof is. You want to know how old the AC is. Are you gonna need to swap out the AC 2 months after you move in? These are all things that you can find out from an inspection, and believe me, it'll come out significantly cheaper than it would for you to actually move into the property to later find out that you need thousands upon thousands of dollars of repairs, which also allows you to leverage for repairs and things like closing costs if there is significant damage done to the property, which allows you to get a better deal, again, especially if it's a starter home. And of course, you can't forget the appraisal, because the appraisal pretty much means that that home is worth what it is that you're purchasing. So if you're purchasing that $300,000 home and it comes in at $305,000, then congratulations, you have now come in with $5,000 worth of equity. But if that home comes in and it appraises at, let's say, $250,000, then you're gonna have two options. You can either A, walk out of the deal, or B, you might have to cover the difference between the loan and where it actually appraised, which 9 times out of 10, unless someone absolutely wants the home, and as long as it's within reach, they usually just end up walking out. Now, congratulations, the day has finally come. It is closing day. You have made it through 155 hoops to get up to this point. So you deserve a pat on the back. And you deserve a pat on the back if you've been watching this video up to this point, because I do know that it is a longer video, but again, I did not want to skip any steps. So now what happens? Here's what I always recommend. I always recommend not to make any big purchases without first consulting with your mortgage loan officer, because they're going to let you know whether you can or whether you cannot, if it's going to kick your loan out of underwrite. So don't make any big purchases from the moment that you put an offer on the property to literally the day that you get the keys to the home and you're having your first night's rest in that home. I've literally sat at closing tables where it's literally closing day and they purchased maybe a couch because they thought that that couch would be a good fit for the style of the living room. And it was. But the problem was that they made the purchase before actually having the loan funded, meaning before closing actually hit. And so what ended up happening is, well, they couldn't fund the loan, deal's over, because that threw them out of, which we mentioned earlier, the debt to income ratio. So closing day is your day. A good rule of thumb for the closing costs that you will need for the remainder amount of the loan or the remainder amount of the balance due at closing is right around 1%, which again, you can always find that out with your mortgage loan officer, or you can play around with some mortgage calculators, which I'll go ahead and link down in the description so that you can play with different mortgage calculators of how much down payment you'll need, what your monthly mortgage payment would be, and how much closing costs you would actually need. And so there you have it. I always recommend buying a home as one of the most secure investments that you can possibly make. Now, many will argue that it is not an asset, it's a liability, but it all depends on how you actually plan to use that and what your game plan is on the back end. Because what's the point of renting a property if they are just going to continue to raise the rent on you every single month? When you finally have something that's yours, you can paint the walls exactly how you want it. You can sell it whenever you want. You can cash out on it. Nothing that you would be able to do with a rental property. And so in my opinion, purchasing a home is one of the greatest and safest investments that you can possibly make, especially in 2020 and beyond. I would love to hear some success stories, so go ahead and drop those down in the comments. And if you haven't done so already, make sure to hit that subscribe button if you found value in this content and similar content like this that's going to continue to come out each and every single week. Tap that like button because apparently YouTube appreciates content like this that has a ton of likes on it, and that would help my channel out greatly, especially if you enjoyed today's video. Don't forget to tap that notification bell so that you can be notified every time we have content like this coming out each and every single week. Once again, my name is Irvin Pena, also known as Official. Until next time, everyone, we'll see ya.